Welcome to Nasdaq TradeTalks, where we meet the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Ron Diamond, Chairman and CEO of Diamond Wealth, and Brian, Joyce, and Maddie Radner on the Nasdaq Market Intelligence Desk. We're here to discuss underlying market and macro fundamentals following Monday's sharp sell-off. It is great to have everyone back with us. Welcome back to TradeTalks. And Ron, it felt as if yesterday's sell-off was a bit exaggerated, although the underlying fundamentals have not really changed dramatically.
Well, let me preface it by saying, I'm in the family office space, and this is all noise to me. What happened was that they didn't reduce interest rates. There were 3 jobs reports that came out, and people think that they're behind the 8 ball right now. And that's really what happened. But this, again, the short-term thinking, it's very myopic on what a lot of the investors think. It's all noise. And yes, the market dropped a lot. It's going to come back. And I think that people focus too much on day-to-day. It's impossible to look at through the lens of a day-to-day, week-to-week, month-to-month investment. I think the more sophisticated family, people like Warren Buffett, look at things 5-10 years, not 5 to 10 days.
See, and I would agree with that because there was something for everyone yesterday. You have your intraday and swing traders who like that volatility. It gives them an opportunity to get in and out of positions. But when you think about different time frames, as a longer term investor, it could have been an opportunity, or you just don't even think about it.
You cannot make money trading short term, period, end of conversation. And the way to make money is with patient capital, to buy something, hold it for a period of time and let it grow. And picking the market or figuring out what went wrong yesterday or 2 weeks ago or 3 weeks ago, I typically don't even follow the market because it's a moot point. It's irrelevant.
Yeah, Maddie, anything that stuck out to you yesterday in terms of movement that we've seen, or any trends that you've discovered over the past couple of weeks?
So on the Market Intelligence Desk, we are working with a lot of small cap companies, so we're looking at the Russell 2000 pretty closely. And I agree with Ron. I think it was a bit of a short-term correction. I mean, we look at the performance of the Russell 2000 from the end of October last year to the end of July this year. They've really seen an unprecedented performance. The Russell 2000 was actually outperforming the S&P 500 over that time, up 36% versus the S&P 500 up 31%. In July alone, the Russell 2000 gained 10% versus the S&P 500, which was up about 1%. So that is a little bit frothy, and I think the short-term correction we saw yesterday was just short-term.
Yeah, and Brian, if we pull up a chart of the VIX here, and one of the narratives that was floating around that this was the 3rd largest pop behind the housing crisis and COVID, right? And I think when you look at it through that lens, it's certainly very short-sighted, because if you got out of the market after those 2 periods of the housing crisis and COVID, you missed out on generational moves here.
Sure, and time frame is key. So
right.
We're looking at a very short time frame where in the last couple of days we had a phenomenal move in the VIX. I don't know if the spot VIX is different, as you were referring to earlier, as futures VIX, but still a big move nonetheless. To me, what stood out was last Wednesday's FOMC meeting, Bank of Japan meeting. Hit the breakdown in the Japanese yen on Wednesday below a key technical level. But what also stood out to me locally here in the U.S. is when we had that move lower in rates, like we did after the Powell press conference, you didn't see that explosive move higher in small caps like we had in July when rates came in, or like Q4 when rates came in. And so that was unusual. Actually, banks, which are the most rate sensitive, were actually down on Wednesday, despite that move lower in rates. And the Russell 2000 Financials Index had its best month ever in July. So I think there was a lot of frothiness going into last week's FOMC. You had a more hawkish Bank of Japan as well, so there's a lot of talk about that unwinding of the carry trade. Certainly had a phenomenal move lower in the yen over the last week.
Yeah, and that's why I'm glad you brought up the difference between the futures versus spot. And we covered these yesterday on Trade Talks. That if you looked at the futures, it was at 37, whereas spot was at 65. And there's different intraday mechanics that makes it as such, but you could certainly see the difference in terms of how traders and investors were thinking about the overall environment relative to where we saw those pops. But Ron, to your point earlier, that's kind of what gets the headlines. I mean, I saw it a couple networks, like the font was twice the size it normally is because it's market sell-off. But at the same token, valuations are high, and there needs to be some sort of rotation. Well, okay, you got it. Right.
Valuations are high, but again, this is noise. It's driven by social media and people who are making money by wanting to create headlines. It's really, you cannot make money in the market by looking at it from a short-term standpoint. You can't. And I think people the market's driven by fear and greed, and I think what happens is a lot of people, when COVID happened, everyone wanted to get out of the market. This is the exact wrong thing to do.
Right.
So it's almost like you want to do the opposite of what what a lot of people do. And I think that you've got a huge opportunity right now if you look at things for the long term. Look at 5 to 10 years. Don't look at 5 to 10 weeks. Again,
look at the returns in 5 years. Basically, it's 5 years since COVID. Imagine missing out on that.
It's mind-boggling, and part of the reason that a lot of the private markets have grown so much is you can't get out. You know, they're 3-5, so you're actually forced to hold it. And I think that's part of the reason why a lot of the private markets do better, because the individual doesn't have the ability to just freak out from what happened yesterday and sell, which they shouldn't do.
Well, let's talk some Family Office 101 for a moment here. It doesn't sound as if the macro environment impacts that particular part of the market as much because of the way these types of deals and portfolios are structured. Right.
Look, family offices look at things through the lens of long term, right? And their favorite holding period is forever, right? A lot of the people who try to make money trading, individuals, some do, but it's very, very hard. And I think to create alpha, I ran a hedge fund, and back in the 90s when I ran my fund, it wasn't easy, but it was easier to create alpha in the public markets. I just have money in index funds in the public markets, and I would argue with anybody that that's the right strategy. Where you can create alpha is the private markets, private equity, venture capital, real estate, and credit, so you have to understand that. But trying to get in and out of the market and having mom or grandma call you because it's just noise.
Right, it is just noise. Maddie, let's talk about another area of the market and the IPOs and so forth. Has the volatility recently impacted that? Have deals been pushed off, or what are some of the trends that you can discern from there?
I think we've definitely seen a slow progression of deals come to market this year, especially coming off a very tepid 2023, and I think we're expecting that to continue just because of all the noise that's going on, including Fed policy, upcoming rate cuts, geopolitical tensions. So yes, I think there is a little bit of a delay, and companies might be waiting on the sidelines until 2025 just for when we see those rate cuts to happen, and there's a little bit more certainty with some of the riskier companies that are looking to tap into the public markets.
Right. Brian, let's go back to the yen for a moment here. Why are U.S. markets so predisposed to what happens with the movements in the yen in particular? It feels as if when we talk about other areas of foreign currency, it doesn't impact as much, but when you hear about a yen trade, the dollar is always the first thing that you go to look at.
Yeah, I mean, the markets globally are so connected these days. So when we see things like on Sunday evening, the Nikkei futures down 12% or so, that certainly could impact what takes place here in our markets. So the yen is considered one of the primary carry trade funding currencies, where you borrow in yen because rates are so low, and then you deploy those assets into the currencies and the yields of other currencies, I should say. And so when that trade unwinds, which you could be forced to unwind it because the yen now starts appreciating in value and starts going against you, well, to close that out, you have to close out, let's say if you were invested in Australian dollars, you'd have to close that trade out to then cover back your yen position, your yen short, and so that could have an impact on risk assets globally.
Well, it makes sense, right? So if the best house on a bad market has been U.S. stocks for a number of years at this point, if you have to fund any margin calls that came in or your position in your FX account, where are you going to get that from? Especially if you had the kind of returns that you've had in your stocks.
Yeah, and this is all very short term, right? So we're trying to figure out the ebbs and flows. So Maddie and I, we're speaking to companies on a day-to-day basis. They want to know, hey, why is my stock in the last 2 hours behaving the way it's behaving? So we need to respond to them, and we're looking at broker flows, we're looking at macro data, we're looking at sell-side estimates, any ratings changes, any news headlines, what's going on with your peers. So we're in the business of more short-term kind of analysis and feedback and commentary as to what's going on in the broader marketplace or individual stocks, within rates, within commodities, depending on who and what type of listed company that we're speaking to.
Right. Well, I mean, you cover financials.
Correct. Yeah, so I cover financials. So I'm doing a lot of conversations about Fed policy. So I put out a note, last Wednesday, 2 hours before the meeting, to all of my listed companies, particularly with a focus on regional banks, which are most rate sensitive. Discussing, hey, we've had this phenomenal run coming into the end of the month, when it's now July 31st. The regional bank index had its third best month ever on record. Russell 2000 Financials best ever on record, going back 25, 30 years. So given the technical setup, given the fact that the KRE, which I have here, is running into technical resistance. So right here we're looking at the KRE. It's the most liquid bank ETF we could see as of last Wednesday when this chart is dated. It's running into that 18-month support level that was in place from mid-21 to the end of 22. And then last year in February, March, when we had the bank turmoil, when it blew through that support, it just knifed down for 3 straight days, had its biggest 3-day decline on the biggest 3 days of volume. And so we're now getting back to that prior key support level, which from a technical standpoint, I would expect to be resistance. And so we have seen that pullback.
And I knew none of that, and I don't care. It's a moot point to me. Family offices look at things long term. I don't know what happens on a day-to-day. I mean, if people are trying to figure out what happens hour to hour, that's insanity. You can't. So what family offices, and there's $10 trillion in capital, there's 84 trillion coming downstream. So I think there's huge movement into the family office market. But all the statistics that you just said, which are very important for a lot of people, it's just noise to me.
Sure.
So what do they worry about? Family offices are new for us, so we're like, you're teaching us, and we're
family
curious
offices.
about it.
Look, there's $10 trillion in capital. You've got there's 6.5 trillion globally in hedge funds, so it's bigger than the hedge fund market. You've got 84.4 trillion coming. We've got the largest transfer of wealth in history in the next 20 years, from the baby boomers to the next gen. So, next 20 years, there's 84.4 trillion coming downstream. This market, the family office market, will be larger than private equity, venture capital, and real estate combined. So it's a massive market. The problem today is that, in general, people hear family offices, it's very inefficient, it's very fragmented, and it's very siloed, and the model doesn't work. Only 25% of families make it to the second gen, 10 make it to the third, 5 make it to the fourth. I think what's going to happen is that's going to change. We're starting to see it change. It's going to start changing at university level. And I think what's going to happen is, in 5 years, the top kids out of Wharton or Stanford or Northwestern, their first choice isn't necessarily going to be limited to private equity, venture capital, real estate, or hedge funds. Family offices, in my opinion, in 5 to 10 years will be the first choice that a lot of these kids will go to.
So we might become familiar with some of those names, like we understand KKR and Blackstone.
Right. So I did a podcast with David Rubenstein, and David said his family office is called Declaration Partners. Nobody's ever heard of Declaration Partners, but everybody's heard of David Rubenstein. People have heard of Carlyle. I think in 5 to 10 years, what he said, and I agree with it, that firms like Declaration Partners, people will know that like a KKR. Right now they don't. And I think that's going to change. But it's fundamentally changing the way companies are bought and sold and how everything's financed. So
I wonder if that's why part of the reason companies are staying private for longer is there's alternative ways to raise capital and attract investors.
I ran a hedge fund. Being a public company is not fun, right? You've got to run, and it's not efficient. You've got to run if I'm running a fund and you've got to report to me every 90 days and you've got a widget business, there's no way you could grow that business efficiently versus if you're in the private market. So I think that before people wanted the goal was to take it public. Now a lot of the money is being created. The companies are staying private longer, and a lot of the alpha is being created before the companies go public. Yeah. So the private markets is really where the family offices are looking. I think it's 52% of assets of family offices are in the private market.
Would you say that attributed to the demand of alternative investments, or the reason why there's more knowledge and product out there?
It's a superior return. I mean, if you look at the numbers on how private equity in general, how venture capital, and again, assuming you're working with good people, right, they're better performing markets than the stock market. Like I said, I just have money in index funds. It's very hard. All the stuff that you were talking about is extremely relevant. You hear it on TV all the time. It's so far. That's just like listening to a foreign language to me. Yeah. And I think family offices look at things from a long-term perspective. That's, to me, the only way you could create true alpha, because you might be right one day or 1 week or 1 month, but if your trend is, if the demographics of people are getting older, maybe senior housing is a good place to be. If the trend is more and more people are renting versus buying, maybe multifamily housing is a good place to be. Yeah. And that's kind of how we look at things, top down rather than bottom up.
Yeah. In fairness, though, I mean, you do have to have a substantial amount to invest. I mean, you have a little bit more choice. What was it, 250 million?
In order for it to make economic sense,
right,
you need a minimum of 250 million.
Yeah. All right. Well,
as an investor.
As a family.
As a family too,
right,
for a family office. But again, there's a lot of people who have family offices that are under 250, and they'd be better off at a multifamily office. Because if you do the math, if you reverse engineer
right,
it, and pay your own accountant, your own admin, your own people, versus a multifamily office where you're splitting the cost with 10
So it's almost like outsourcing the expertise in a way.
And the growth is going to be in the multifamily office, not in the single-family office. There's going to be a smaller number of large single-family offices which will compete directly with the private equity and venture capital firms, which will have a superior performance because they've got patient capital, and a lot of the smaller family offices will fold and move into multifamily offices.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.